Welcome to the Dividend Talk podcast, episode 91. Dividend growth investing if we had to start all over again. Hey, everybody, welcome back to another episode of Dividend Talk. This week, we're going to chat about dividend growth investing if we were to start this journey all over again. We'll also answer questions from the community and maybe at the end give a stock pick. All that and more. See you on the inside. It's been so long. We missed the episode last week. How have you been?
Hey, EMF, nice to see you again. Well, I was under the weather with COVID, right? Maybe you still hear it from my voice.
Yeah, you
So,
have that rich Barry White kind of sound coming out of you now.
yeah, driving home for Christmas. Nah, I had a really heavy flu. I was literally 4 or 5 days in bed, couldn't get out. And I'm still suffering a bit because I've got low energy typically. After 2 3 hours at work, I need half an hour to an hour break, preferably with a power nap. And I have also these brain fogs. So sometimes my brain is just tired and nothing gets in, nothing gets out. Some people are happy with that, but for me, it's quite annoying sometimes.
Yeah, but I mean, it's good to see you. I know. Look, COVID is not nice, but it's good to see you. You look okay, which is the main thing. But as I said, you still have that Barry White kind of sound, so still a little bit to
Yeah.
go.
But how about yourself then? Because you also had some illness, right?
Yeah, good. I didn't have COVID, touch wood. I just have this problem with my throat, so I couldn't speak. My wife was probably happy for a couple of days. She had a bit of peace and quiet, but uh, as you can hear, back to normal, so all good on my end. But let's try get your energy up a little bit, talking about dividend stocks, and maybe is there something in the news? Is there anything in the news that popped into your mind this week?
Yeah, definitely. And probably some listeners get fed up that we bring up Intel again. But Intel is such an interesting stock for me and company to follow because of the turnaround that they are doing.
Hmm.
And did you know that they have plans of up to 80 billion, according to the news item I read, to invest in Europe over the next decade?
Wow.
And they want to build a semiconductor plant in Germany, in Magdeburg, and that will be like a 17 billion euro investment. And Magdeburg is always on the drive to the Netherlands for me on the road. And usually we stay there, stay over there for the night. So, and I already feel like, oh, maybe it's ready in 1 or 2 years, and I should just visit the plant just to see how it looks like. But this is very interesting, right? Because we see a lot of geopolitics going on here. Also, Pat Gelsinger was on I believe, I don't know if it was the Senate in the US where he was answering questions this week. But it's clearly an industry that asks for a lot of protectionism from the governments because it's high tech and we need all this tech, right, to
Yeah.
stay competitive.
Hmm.
And it's very interesting that Intel wants to invest also so heavily in Europe, right? And I was also thinking maybe that Europe, because Europe also had this plan to invest more in semiconductors, but I was maybe thinking maybe they will invest more in European companies, right, or subsidize it. And what is really interesting for me here is now as an Intel shareholder is that there will be a lot of subsidies here. Yeah.
Yeah.
And this makes it more attractive also as an Intel shareholder that Intel doesn't need to take the full cash burn on everything that they want to build up. And we know once they build this up, it's infrastructure that is there, unless semiconductors get disrupted, right? But
Yeah.
otherwise, it's going to give us operational cash flow for years to come.
Yeah, they're starting to have a huge presence in Europe, which is the first thing that sprung to my mind when I read this. We know they're expanding in Ireland as well, and adding a few more plants here and there. So it's quite exciting. And I mean, part of me wants to see some of these grants go to more European companies because we are Europeans and we push that. But then
Yeah.
as a shareholder, I'm not a shareholder in European semiconductors, so as a shareholder, I'm happy it's going to Intel. So it's kind of a bit of both. But I think Pat's playing a great game. He knows he clearly knows what he's doing. He's trying to force America's hand a little bit as well, trying to
Yeah.
get it, trying to grab as much as he can from them. So I think he's doing a good job.
Well, and I assume he needs some machines from the Netherlands, from ASML.
Yeah, of
And
course.
did you know that ASML's market cap is bigger than the one from Intel?
No, they're not.
No, it's a fun fact for your trivia when you're playing games with other dividend growth investors. So ASML is having a bigger market cap than Intel. So, and I assume they need some machines there as well. So in the end, ASML is also such a great growth story, right? Um,
Yeah, it feels like the growth story I missed. God damn
yeah, yeah, like the other 80 stocks that I missed.
it.
How
um,
about yourself? Did you see anything in the news?
not a whole lot, but I did notice. I think today on Yahoo that AT&T have announced some details for this long anticipated split. I think the next dividend that they will pay will now be the reduced version,
Hmm.
so it'll be no longer, was it 52 cents? I think it
Yeah.
was. So I believe that shareholders, myself included, will get 0.24 shares in the Warner Brother Discovery stock. So if you have 100 shares, you get 24 for them. Um, and yeah, see how it goes. So it's now going to happen. So it's going to be interesting to see. I think over the next year how AT&T now navigate that they got rid of this. Will they start focusing on depth or how they actually grow as a company? And it's a little bit exciting as well. Look, I'm a bag holder. I'm not going to sell them now. I'd lose too much money to sell them now, so I'm in it for the long haul. I still get a decent dividend yield out of them, so we see how it goes. But yeah,
But
go on, give me
come
your rant.
on, come on. No, but this the CEO of AT&T, do you really trust that he will be able to do a boring job by just paying off debt? After two
Yeah,
months, he will talk to an investment wanker in New York, and person will say like, "Oh, you know what you should do? You should go into satellites or something like that." And then he will buy an overpriced satellite company.
maybe we don't know what's inside the brains of the CEO, but I mean, look at
Well, we
Uni.
have seen the evidence, right?
Look at the evidence of Unilever. We've seen that too. We know CEOs are not perfect. It doesn't mean it's to the detriment of the company all the time. We just have to wait and see. At the moment, the split's happening, and we have to just take a step back and wait. Especially as a shareholder, you just have to wait and see how they play it. Then I'll have a decision to make. If in a year or 2 years' time the CEO goes off and does something crazy, I'll have a big decision to make. But at the moment, there's not much I
But
can
how
do.
does that rhyme with your dividend growth philosophy if it's cutting the dividend? And
It's cutting the dividend because of
Mhm.
the split. Okay, so it's a technicality. I mean, if they weren't splitting, maybe they would not cut the dividend. So, but the yield is still quite high, right? You're still getting a
Mhm.
juicy yield. So I think there will be an opportunity for them to grow that now because obviously,
Yeah.
so we'll see. We'll see how it goes. I'm not treating this as a dividend cut like I don't know who cut theirs like Shell for example who just
Yeah.
cut the dividends. These
Yeah.
guys have split and it's cut because of that. They could not possibly. If I would have been a little bit more concerned if they kept the dividend at the same level while cutting off the company
Mhm.
because they clearly could not afford that.
Yeah. Yeah.
They could not afford it. So we'll see.
Okay. Fair enough.
We'll see. Anyway, we'll move into the main topic, which is a little bit inspired by some questions that we got, particularly from Simon Scott. And I think it's off the back of a comment that you made about buying high yielders, particularly in the beginning, to build up some cash, so to speak, and see how you go. So we decided to talk about what we would do dividend investing if we had to start it all over again. And we quickly typed this up each before we did it. So I think we have some opposing views on it, but how would you start?
So maybe to also to go to that question, right? I would still start with some higher yielding stocks.
Yeah.
And why? Just to get this feeling of dividends coming in. Yeah, and not like half a euro, but that it's kind of that you can envision like, oh, today my lunch was paid by my monthly dividends. Because that what we're talking about, right? 10 euro a month, 15 euro a month in the first month. So really that you can feel like the dividends are already meaningful. And also I think a bit of like these stocks also give you a feeling that you're investing in dividend stocks or dividend growth stocks, right? So, for
Yeah.
instance, a company like British American Tobacco or something like that. I know my wife, by the way, other thing I would do differently, I wouldn't tell my wife what I'm investing in. So, but maybe also some Enagas, right? Or Unilever, 3M, maybe an oil company like Chevron or Royal Dutch Shell at the moment, or Total Energies, maybe even utility. Yeah, so I would invest a little bit in this so that I can really start counting money that's coming in, and even that if I would like to reinvest it, that I already feel like, oh, that's actually 2% more than my monthly investment or something like that. Yeah, that it really starts to feel so. And I would do this probably with the first 10,000 euros. It depends, of course, on what I have to invest. But at that time, I was investing like 1,000 euro a month when I started. So if I would be in similar position, maybe I would do it for the first half year. So let's say 6,000 euros, and just to build up a little bit of that. And I know that it would a little bit be a mishmash of everything. I also think in the beginning it doesn't need to be the strategy yet already, that you have everything pre-written how to do what. If you have that knowledge at that time, great. But I think it's more like to get started, to get this feeling, to also feel that if you put 1,000 euro in the stock market, that you don't lie awake when the price drops 10% to 900, because
Yeah.
you need to go as quick as possible into getting used to that you're deploying 1,000 every month, or 500, whatever it is. But like everything you have left after your expenses from your salary, that you're just putting in the stock market, and that you really quickly learn this feeling that that actually when it goes down, that's an opportunity because you get more shares of the same. After half a year, I would assume that I started to look around more, that I really started to get my hands around it, and I would probably start investing a bit in more high quality companies, in the sense of the lower yielders. I would still would like to have my portfolio yield always around 3 to 3.3%, because that's where the compounding makes sense, right? On a
Mm.
1% yield, compounding will take so long, even if you have like if you expect 10 plus percent dividend growth, it's really hard to have this in a cohort over the next 10 years, more than 10% dividend growth. Even so, low yield is today, in 5 years from now, they might be having a price crash or something like that, or their growth might be stalled. So I would not bet on a company now, let's say, having 1% yield and then extrapolating the last 5 years of 10 or 15% dividend growth into the next 10 years. I wouldn't bet on that, really not. So I would really want to have my portfolio yield always around 3 to 3.3% yields, so that the compounding makes sense. Because then, maybe depending on your plan, you could be after 15 years financially independent instead of after 30 years. Yeah. So I would look at it from that point of view more. So, and then I would think about Johnson Johnson, a little bit of Microsoft, maybe even Apple. I know they are richly valued, but I would at least mix up a little bit with the high yielders that I started off with
Yeah. Yeah.
there.
I think the most important part of that, and I actually did not mention this or did not write it down, is getting the feeling of putting money into the market at the beginning. Is it can be quite intimidating, and
Exactly.
a thousand euro, $1,000 is a lot of money, and it's particularly for newbie investors who, let's be honest, they're investing because they want to get wealthy, or they think they're going to make a lot of money. And I suppose our style of investing is not going to make you rich quickly, and I think that's really, really important to understand.
Yeah.
It's a long term game. You should only be investing money you can afford to lose. So when I started out, it was very small, and I invested money. Whereas if I lost it, it did not impact my lifestyle at all.
Yeah.
And
Yeah. Yeah.
that's key. That way I can sleep at night. So if I was to lose whatever's in my portfolio right now, if the market's tanked or we're in Russia and we could not access that money, my lifestyle doesn't change because
Mhm.
I don't need that
Yeah.
money. And that's the key part. I think that's the key part from what you said. I think it's really important to do that. It don't have to be 1,000. It can be 100 euro. It can be 50 euro.
Yeah, but
Whatever.
think about what you can do with, let's say, 500 euro, right? You could take a weekend away to Budapest,
Yeah.
or okay, Paris is maybe a bit more expensive depending on where you stay. But this is a lot of money, right? If you're usually putting on savings account for such kind of things,
Yeah,
then it's a lot of money.
yeah. I'd agree with that. Where we differ slightly in this is my approach will be a little bit different to begin with. Okay, I would forget about the dividend at the beginning. Right, dividends won't matter. So high yield or low yields do not matter for me at the beginning. My main focus and my sole purpose in the beginning for the first year would be to pick 5 companies that I know and understand fully. So companies I'm already aware of. So companies like Schneider, ABP for me, Texas Instruments, Microsoft, companies I already know and understand, and just invest in those 5 companies, not only in money but in time. I would read all their annual reports. I would read their news every single day. I would just immerse myself in these companies that I understand them, understand every part of the company from the financials to what they do. Basically, act as if I'm like a CEO of the company. You know, try really get into it, understand every part. And I think a year of that with 5 top quality companies that you know will will not go anywhere. Your money is relatively safe. I think you will learn a lot. I would personally learn a lot from that because the way I started was I invested in a load of companies. I don't know 20, 30. I think I had 40 companies at the same time. There's no way in hell I could keep track of that. And then you're getting yourself in a mindset where you're trying to keep up. You're reading headlines and just headlines. And you all know headlines are just made to look juicy and nice. You're not getting into the meat of the company. You're not understanding the financials. You're glossing over everything. You don't have enough time. I would just pick 5 companies, understand every part of it, and then from there start to develop into other areas. That's when I would start to maybe think about adding yield. Maybe that's when it becomes a little bit more important to me. Picking, like you said, adding under sub 1 is not much good to us. We want 2, 3, 4%. I would slowly build up my list and then start thinking about valuation at that point. Now I want to be getting in at good prices. I want to be maximizing my total return. And that's probably the main steps I would take if I was restarting.
Yeah, and it's indeed really different. I think the difference in approach is probably because of how we are, how we have learnings in the past. So my issue in the beginning was not investing consistently. Yeah, and that's why I missed
Yeah.
out a lot. Um, but I also remember, like, I just remember. So my investing journey started actually more with a book of it was a Dutch guy, Gerard Horman, I believe,
Mm.
who had a book Hypotheekvrij. So this was a book about paying down your mortgage, and I learned there about the compound effect as well. Yeah, so if you for instance pay off every month 500 euros of your mortgage, and then next month you can do 505, and then
Yeah.
510. Yeah, and that's how it goes quicker and quicker and quicker. So that's really what inspired me at the time and got me into this mindset, and that's why I probably also started thinking about yield. Yes, to have this compound, because
Yeah.
this compounding really gave me magic. Like whoa, it's not like you can it goes quicker after time, right? And that's the thing that I would. It's like heroin to my body. Yeah, I see it now as well. If I see now, for instance, in May, then that will be coming a really big pay month for me with the European stocks, right?
Yeah.
And I probably I could, if I really would live like a Scrooge, I could probably then live just in May already of the dividends, right? And this for me is like, yeah, like heroin, dopamine, whatever it is. But yeah, that's the true power for me of dividend investing and dividend growth investing.
Yeah, and I get the psychology of that, and you want to see the cash coming in, but then you have to think about this as a long term gain. You're not going to invest unless you're absolutely loaded, but you're not going to invest a lot of money that's going to be life changing in a short amount of time, particularly in a year time frame. For most of our listeners, would I would
True,
class, do you know what I
true.
mean, class at that level. From what I see and from what I did, I followed people, right? I followed dividend
Mm,
investor, right? Dividend growth investor. And you're not, I mean, look, he writes an article and you're going to read the article and you're going to go, okay, he wrote about that. I know about the company. I don't know about the company. I know what he
yeah.
knows, what he wrote. That's all I know. and then you get into this kind of a sheep mentality, and then you might be on Twitter and somebody say, "Oh, ZIM is a good stock." So you go, "Oh yeah, yeah, they are," and you go and buy them. You're not understanding anything. Whereas
Yeah.
I think, for me personally, it's now better to go and understand the company, and then invest, because
Yeah, and
I had
that's interesting what you say, because it is really about personalities, right?
yeah,
Because I had that a little bit, but I was more inspired by Dividend Mantra than Dividend Grow Investor, because Jason Fieber was more talking about his life, his lifestyle, and that inspired me a lot. And from all the stocks that he recommended, maybe one or two he inspired me to buy, but mostly I was just going to driptools.org, downloading the sheet, and checking which look like attractively valued for me, not
yeah.
knowing really yet how to value a company at that moment in time.
Exactly, and that's the problem when you start, isn't it? How do you value a company when you actually, not even when you start, even now, how do you value a company? You look at PE ratios, price to sale ratios. Do you know what I mean?
Yeah,
All loads of different methods, but really it's an estimation, isn't it? And
yeah,
your best guess and your best way of valuing a company will be to understand that company, and then
yeah,
you will have a story, you will have a picture of where they are now, but more importantly, where will they be in 5 years' time? Because that's where the
yeah,
valuation is, isn't it?
yeah, yeah. True.
That's where it comes. So, I would, if it was me starting again, I would focus a little bit more on understanding certainly the three financial statements, but just understanding the company, the story, what they're doing, anticipating like a CEO, what are they going to do next? What would I do next? If I was the CEO of this company, what would I do next? I would write it down,
Yeah,
and I would see if my thesis plays out. And
yeah,
like that dollar cost average in, and focus on quality. I would then add the likes of Enagas, Walgreens, all these little bit riskier companies as well into the mix. But I'd slowly build them in.
yeah. And there's one little thing that I would still consider doing at that time. What I really like sometimes is that, for instance, and we spoke about AT&T, that you buy as much of a telecom companies until your internet bill is paid, your monthly internet bill,
Yeah,
kind of, right? And or buy enough oil companies until your gas is paid. Just because what you get a direct connection to your lifestyle, because you're a consumer of those products, you can invest in them, and
yeah,
then the dividends pay actually for your expenses as well. So I would definitely do two or three of those expenses that you have,
yeah.
and try to find companies that will pay it for you.
What what do you think of the approach? And there's lots of people that do this. Hummingbird, Dividend Hummingbird, I think, is one where they just buy hundreds and hundreds of companies. So they don't really need to focus on the financials of a company too much, because they're buying, they're like a huge ETF basically. They're
Yeah.
buying hundreds. What about that approach
I
for the
yeah,
dividend?
I'm flirting sometimes with that approach. I know that I've got this four-tier system with 40, but sometimes I'm thinking like, why not, if a stock is below, let's say 20 PE, has a growth rate of dividend growth rate of I don't know, more than 5%, a payout ratio under 60%, and a yield of 2.75, just buy it. Yeah. Sometimes I'm thinking like that, and that's what they're doing, and I think it makes investing simpler.
Yeah,
There is some, based on that, there is some dividend safety in there, but you also have the dividend safety just by having 100 stocks. So
yeah. I mean,
yeah, sometimes I find that really interesting to do it like that, because it saves me so much time.
a dividend cut for these guys from one company, two companies, three companies probably would not dent as much as it would our
They wouldn't
portfolios.
notice. Yeah, exactly. Exactly.
It's
And they
it's
might outperform me also with that, because effectively they have a whole index. Yeah.
yeah, it's an interesting approach. And sometimes I'm like you. Sometimes I'm the same. I'm like, maybe 40 stocks is too limiting, but then on the other hand, you're thinking, oh, maybe 40 stocks is too much.
Yeah.
It's a constant battle that you have with
Yeah.
yourself all the time.
Yeah. Good. So, hey guys, this is what we would do if we would start all over again. Of course, we are biased based on our own learnings and experience. We would love to hear also from you what advice you would give to other listeners. or just share it on the Facebook. So if you go to Facebook and look up for Dividend Talk group, Dividend Talk, you will find the group. Just announce yourself there and let us know what you would do if you would start all over again. I think this is really interesting. Also, we know that we have quite some new listeners also to the podcast because we get these kinds of questions more often. So yeah, just share it with the rest, with the community, and yeah, very curious to hear from you about that.
Cool. So we might start into some of the questions. First of all, thanks to Simon for that question. It did inspire the show. So thank you for that. But Tony has asked us a question. A question popped into his head recently after listening to a podcast in relation to currencies and foreign exchange. Is foreign exchange risk change something that you factor into your decision making? And if so, how does it impact your decision making on stocks? This might be a little bit more relevant to you because you have to juggle three different currencies.
Yeah, so because I'm in the Polish zloty currency, right?
Yeah.
So actually, I just do dollar cost averaging. I know that I can't predict the currencies. So I rather dollar cost average. Although last week or 2 weeks ago, with the war starting in Ukraine and suddenly the zloty to euro went 5 zloty, I thought like, okay, now I need to be wiser. Now I need to watch out because it was kind of escalating really quickly, too quick. I was expecting it to drop down a little bit. It did. It's now around 475. In the grand scheme of things, it's not too much, right?
Mm-hmm.
So I'm dollar cost averaging. I don't know how to deal otherwise with currencies. What I do find important is that I'm not 100% in US dollars. So what I strive for is maximum, let's say 65% in US dollars and the rest in euros, because euro is more the natural currency that I would pay for also if I wouldn't be living in Poland anymore. So I wouldn't like to have everything in one basket, and it's not needed because there are lots of great European dividend growth companies around there. So naturally, I already diversify in currencies via that.
Yeah.
Other than that, I'm not looking at it.
I think if you dollar cost average in every month, as I know I do and you do, I think it's not that it's not relevant, but it's less relevant because you're going to have times when it works in your favor and
Yeah,
it is against you. So if you're dollar cost averaging, you expect it to average itself out. If
yeah,
you are a lump sum investor, so you are investing maybe once a year, you have whatever,
yeah.
10
That's
grand.
a different story.
It's a different story because you have to pay a little bit more attention because you get one chance to buy. You want to try and maximize it. So
Yeah. And that this is mainly a question the accumulation phase, right
yeah,
here, because a stronger dollar is better when you are in the retirement phase
of course,
because you get
because
more
get more
euros and
money.
dividends.
Yeah.
Yeah, exactly.
Okay, Andres has asked us our thoughts on Carlsberg AS, which is a Danish brewery, the fourth largest in the world, and paying an annual dividend since 2001.
Yeah, I looked a little bit into it, Anders. So I didn't study it, but first of all, I like that it has been growing its dividends since actually 2008 when it cut the dividend. I believe it had one time a frozen dividend in 2010, so it was flat. But the dividend was then around 350 in Danish crowns. It's now 24. This is like a sevenfold in what is it in 12, 14 years?
Yeah, yeah,
That's insane, right? It's really really rapid growth in dividends. So lots of beers went into that, I think. If you look at today, still payout ratio of 51%, dividend yield, starting yield of 3%. So it actually looks quite interesting. It passes my screener criteria. I looked a little bit also into the revenue growth and profit growth, and it looked like a bit fluctuating here and there, but generally it went nowhere over the last 4 years. I
yeah,
can imagine that COVID had an impact here. So I really would want to know more about what's the true earnings power of this company and true growth, taking COVID into consideration. This would be for me a very important question to ask here. But hey, Anders, thank you so much because I always felt like Heineken should be such a stock, but Heineken is cutting the dividend every time. It did it also during the pandemic, and Carlsberg just kept on growing. So it really tastes like more this stock. I'm quite intrigued.
yeah. It'd be good to compare it directly to Heineken. Uh, Obviously, that's
Well, then Carlsberg is better from a dividend growth point of
from
view.
from a dividend growth point of view. In
Yeah.
terms of taste, Heineken wins hands down.
Yeah, well, that I leave to the other
Yeah,
people.
but it does look. To be honest with you, Andres, I never even thought of looking at Carlsberg for something like this. But looking at just basic numbers at the moment, it does look quite interesting. And as I said, it would be. I think it would be a nice topic maybe to do. Um, a comparison of such companies. I'm sure there's other breweries out there as well that might add to
Yeah.
that list.
Good. The next question is from Carlos Terry, also for Facebook, and he says, or he asks, how to read a cash flow statement. So he's wondering where to look for such a course, because you were recommending that in the past, right? Around the three financial statements.
Yeah, I can't remember I can't remember if it said the course. I know I mentioned Investment Talk, who was on Connor was on this
Yeah.
podcast, and he had an ebook at the time, pretty laying out how to read the financial statements. I also recommended the book by Warren Buffett as well.
Mhm.
So I will post links to both. I don't know if Connor's is still available, but I will post it if it is. In terms of courses, I can't remember if I did a course, but I did do something on dividend investing before, not specifically on the three financial statements though. So
Yeah. And then there's one book that I have. It's called Guide to Analyzing Companies. It's written by The Economist. You can find it on Amazon. I can also paste the link there. It talks also about the financial statements, but not in such a clear way as the book you mentioned from Buffett. But I use this one more like Wikipedia, because it explains all the metrics. It explains all the typical accounts on the balance sheet. So if
yeah,
you see something awkward on the balance sheet, you can go to that book and it explains you at least what that account means, and if there's anything that you should be aware of,
yeah.
or what's specific around such an account. For
What
me, that
what
really helps me.
what I will say is those books are quite technical. They can be quite technical, and you need a certain ability. I would say not a certain ability, but they can be quite cumbersome to read. The
Yeah,
Warren Buffett book, he's now 11, nearly 12.
yeah.
My 12-year-old read it. He understood most of it. He came to me with questions, and we've gone through Coca-Cola's financial statements. I let him lead to go through it, and he was able to go through, and we could reference the book. So if an 11, 12
Ah,
year old
nice.
can read the book and understand it, I'm pretty sure it's a good place to start for most people.
Yeah, definitely. And also a book like which is not about financial statements, but One Up on Wall Street from Peter
Yeah,
Lynch. He explains really nicely the price to earnings multiples. I believe also the PAC ratio, right?
yeah,
Price to earnings growth. So that's also a nice lightweight book, but also a bit inspirational, right? Yeah. But the Buffett one it is, I believe, right?
yeah.
Yeah.
I will post a link. I will write a reminder down. I won't forget. Um, the next question was from an email that I got in from Snorkel Diving, and he was asking us, would we ever invest in ticker symbol JEPI, which is JP Morgan Equity Premium Income ETF? Um, so I'm not sure if you know
So is
how
this
that works.
similar like QYLD?
Yes,
Yeah.
pretty similar. Yeah, so they do hold some good companies, but they do sell obviously covered calls to enhance its income and distribute a high yield.
I've been tinkering with this thought, right? So QYLD is not accessible for me as a European investor. Probably I would need to sell some calls or sell some put options and then own them via that. But think about it. I don't know what this yield is here, but with QYLD, it's a 10% yield. Yeah.
Mm,
Let's assume that I'm now 35% dividend expense. I said retirement progress. And let's assume that I also have like a 3% yield. If I could get for the same money 3 times more, I could stop working today,
yeah,
technically, for the same portfolio value that I have now. And then I could just, ditch all the money in there, get this cash flow in, still work a little bit to put a safety net on top of it. And I could stop working already today. Yeah. So for me, it is really, really an attractive thought. But I also know it will be poison for me. I will really burn myself probably on this. But sometimes I'm thinking like, am I the idiot here?
Do you know what? First of all, this JEPI ticker is not accessible. It's the exact same as QYLD for us.
Okay.
Not accessible. I tried to look at it on Interactive Brokers. I can't buy it, so it'll be the
So
same
it's the
thing.
same fuckers from the European
The same
Union
thing.
again that wanna
Yeah,
think for us.
protect us.
Yeah.
So I don't know a whole lot about this. I do know that obviously sales covered calls, there's going to be risks associated with that. And in terms of downturns, these type of tickers do suffer quite heavily. But on the opposite side of that is if you can get them at a low price and even higher yield, you will benefit substantially for them. There is ways around it, obviously, like you said, but there's also other options for us. So we have closed-end funds that we do have access to that do distribute 8, 10, well, typically between 6 and 10% yields. All Star Growth, ticker ASG, is one that I have, for example. Um, there is lots of other different ones. The problem with CEFs is they use high leverage. I don't know if this ticker JEPI,
Mhm.
if they're highly leveraged. Maybe they are, maybe that's where the risk comes in. And there's other options that are not as leveraged, but there's definitely ways out there to increase your income. Dividend Bull on YouTube is actually a good follow because he covers all sorts of these types of companies. He doesn't necessarily recommend you to buy him, but he does highlight the different options that are out there. So if you are chasing higher yields or are chasing these types of ETFs or companies, I recommend checking him out. Don't take my word for it because I don't know these companies as well. But it's hard, isn't it? Because particularly on Twitter, when we see all these Twitter gurus going around and they invest in thousands in these companies, um, we're sitting here. Maybe do we know better? Do we not know better? These guys are making 3 times the amount of money we are with less capital. It's
Yeah.
so
Yeah.
it's hard. It's hard. Would I invest in a company like this? If I could, I would seriously consider it, but I can't, so I don't bother to look at it.
Yeah.
That's my take on it.
It might have a place in my portfolio, but just for a few percent, right?
Not
Just to spice up. Yeah.
not a core holding by any means,
Yeah.
but I mean having a couple of percent here wouldn't hurt.
Yeah. Exactly. Good. Thanks for the question. Very interesting, and it makes me dream already of how is it? Retiring tomorrow. Next question is from Thiago Diaz, and he is asking if we have any thoughts about UNP ticker symbol. So Union Pacific, I believe,
Yeah,
the choo company, the
train
trains.
train company. I'm not overly familiar with ticker UNP, but I do know a little bit about Canadian um, Pacific companies, so Canadian Railways. So they're both railway companies. The only thing I'll say is that they have a really wide moat, or as in they can't easily be replaced. Once you have a
Hmm.
railway company, they're there for life. It's hard to replace it. Looking at the financials, it looked okay. You can see revenue was flat. We do see operating income is increasing, which is good. So gross margin is obviously going up. The earnings per share was increasing at a ferocious rate because they're buying back shares aggressively. I think they've bought back 35% of the shares in the last 8 or 9 years. So they have been increasing the earnings per share there. Their dividends are easily covered and increasing, which is good. But then we come to their debt, and that is also increasing, which is not so good and a little bit worrisome. I don't know the company. I don't know what they do. I don't know if they transport goods, people. I don't know, but it is a little bit worrisome that they're increasing their debt at a really fast rate. And they do look a little bit overvalued, and I'm not keen on companies buying back shares at a high price either.
Yeah, good one. So I hope this answers your question, Thiago.
Yeah, it probably doesn't. He's definitely going to look at it more in depth than we are. But I mean, in terms of moat, I think railway companies are a no-brainer, but they probably are overvalued. Most of them probably are overvalued based on that.
Mhm.
Centrino has asked you, will you meet Biden tomorrow, President Biden?
I have nothing in my calendar yet, so I was not planning to, but I assume that he's suggesting that Biden is coming to Poland because
Yeah,
I've
yes.
not been. Yeah,
Yeah, yeah.
okay. No, so no, I'm not so interested in that, and also not in politicians. Yeah.
Who knows?
Anyway,
Politics is strange. This is why we stick to dividends, not politics.
yeah, exactly. We shouldn't talk politics, but yeah. So no, I'm not meeting him tomorrow. I was not planning to.
Dividend.xe, welcome back. Hope everything is okay and all is good. He uses a discounted cash flow, dividend valuation model, and EPS valuation model to calculate fair value. So he uses three different valuation models. What do you guys use to find your fair value of stock?
Yeah, the same. I'm most fan of discounted cash flow. It applies to 60-70% of the stocks I analyze. When you talk about real estate, you need to know about, for instance, the FFO, funds from operations. I would say insurance companies, it's probably better to look at earnings, net income, although they are also really, really hard to analyze. And some companies are just better to look at it from a dividend point of view, treat them as a bond and do it like that. So I use the exact three same ones, and then sometimes I look at some metrics in the mix. So I don't only look at what comes out of the formula. I also look at some, balance sheet metrics, and all again based on the three
Yeah.
financial statements.
I like to compare them against their peers as well, just to get a sense of where they are in the market against their peers. Are they overvalued, undervalued, and why?
Yeah, same here, and also from a operational excellence point of view.
Okay.
Okay, and then a dividend collector is asking us what our thoughts are about Vopak. I don't know if you know Vopak.
No, I missed this
Okay.
question. I didn't see fallback.
So Vopak, you can find it with the ticker symbol VPK, v, VPK on the Dutch Stock Exchange. It's effectively how you call that? It's where they store the oil and gas. Those big tanks in the harbors. Those round big things, and they
Ah,
put oil in it, and
yeah.
and they can store it there for a year or more.
Okay.
Many reserves are stored in there. And Vopak, what is really interesting, it was one of my findings when I did the article about Dutch dividend stocks. It has already 20 years of dividend growth. It has 3.5% compounded annual growth rate over the last 5 years in the dividend. But you know what the issue is here for me, although it has like a 4.5 yield, it has also a really high payout ratio, around 90% at the moment. So I don't find their dividend entirely safe. I understand why div collectors looking at it. Also now with the deal maybe with the US, where Europe will buy a lot of LNG, maybe they will need to store it there as well. Usually it's a good hedge towards the oil price. So if oil goes down, usually Vopak does well because people want to store oil then and sell it later. Um, Although I like the company, I don't like it so much as a stock.
Yeah, I get that. So I quickly just looked at it on Morningstar without knowing the background behind the company, and revenue has been falling since 2012. Gross margin has been decreasing. It's decreased by 10% over that time. Operating income has gone down. Earnings per share has gone down. Pay ratio has gone up because dividends has increased. So automatically, my brain is telling me, okay, there's something not sustainable about the dividend here. Debt is manageable. It's not. I mean, it's increasing slowly, but not at a huge rate. But for me, just looking at those numbers without anything else, it would not interest me to pursue this company any further.
Yeah,
Yep.
good. Then the next question is from Dionysus Grifsafinis, and he's asking about our thoughts about ticker symbol APD, and that is Air Products and Chemicals or something like that.
Air products and chemicals. Yeah, I mean, they are at one of the top companies out there. They're a company that I'd like to own. I think the kind of capitalist has them, has been beating the drum on them for a long time. They just always seem really expensive. Again, just looking at the main metrics that we look at: revenues increasing, gross margin increasing, operating income increasing, dividends has gone from 250 in 2012 up as far as 6 now, so it's nearly increased. It's over doubled in that time. Payout ratio is around 60%, which is okay. Cash flow is going up. Overall, it's a company I'd really like to own. It would be maybe close to a tier two, tier one company for me, but it's just so expensive all the time, and I just can
Yeah.
never find an opportunity to get in on them.
Good then. Thank you for the question, Dionysus. And the last question, or almost the last question, is from Dave S. And he's asking for my view on Pepco and other gems on the Warsaw Exchange. So first of all, Dave, I've looked at the Warsaw Stock Exchange several times because I get a lot of this question from Polish people about dividend stocks, and I don't unfortunately see so many gems there, at least not from a dividend growth point of view. Uh, Pepco is also not a dividend growth stock, so it's just a stock, let's say.
Yep.
But Pepco as a business, I love it. I mean, we also go there sometimes. So for Dutch people that are listening, Pepco is something like the HEMA. It's
Yep.
kind of a stock with a company with stores, right? With cheap clothes, cheap everyday goods that you can get there, like for in the house, for decoration and such, clothes, and really cheap. I don't even know where they have sourced it. I hope not from Chinese children that are making it or something like that. I'm always wondering about that because it's too cheap to. But they are growing really, really rapidly. They added 16% in stores last year, and I think they went from 3,500 to 4,000 stores or
Wow.
something
Okay.
more. In Europe, I think they're in 17 countries right now, so quite a lot. And it's quite impressive, their growth track record. Just the multiple of 36 is a bit on the high end for me. I think they IPO'd last year, so they are trading around the IPO price again. So I haven't done a full analysis. I like their business model really a lot. They are profitable, which is also really good. They are rapidly growing. Just the earnings multiple, I would do more due diligence around that, whether it's really an appropriate multiple to pay for the stock. But I could see Pepco as a future dividend payer, as an example, once growth
Yeah.
slows down. So it's definitely something that I would like to have on my far distant radar.
Yeah. 36 multiple P ratio is hard to justify unless you think they're going to continue this growth over the next 10 years. If so,
Yeah,
36 is a no-brainer, but you would be hard pushed for me to convince myself that a PE ratio of 36 is worth buying.
exactly. So thanks for that one, Dave. And then we got a last minute question coming in
Oh,
from
good.
Future Dividends, and he is asking, are you concerned about getting old and finding that you can't keep up with portfolio management or passing off to your spouse after death who may not be interested in managing?
Good question. No, not particularly. I mean, we're all going to get old, and the whole point of this is that I can retire a little bit early and start to live off that. If that doesn't happen, if I was to pass on and this was to move over to my wife, she would probably just sell it, sell the whole portfolio, and use the money as she sees fit. So no, I've no issues in terms of my kids. They have their own portfolios that they're starting to manage and look after themselves. So I'm setting them up for their future. So that money is there for me to retire, to enjoy, and to live life after I retire. And if not, my wife can do what she wants with it, but she's certainly not going to manage it or that. So
Does
she'll
she
just
know the
sell.
login details?
Do you know what? She's been asking me that on an increasing basis. I'm getting quite worried, but I do. I have them stored in a safe place, so she knows where to get them.
Okay, good. So thank you all then for all the questions. I actually had still one question because I thought you bought Zim,
Yes,
ZIM ticker,
I did.
for dividend harvesting, I believe, right?
Yep, yeah, I did.
And it's a container shipping company. So tell me, how did it play out for you?
It worked out okay. It actually would have worked out a lot better if I had have bought them directly after we spoke about it on the show, because I think they were trading around $75. I waited until the following Wednesday or Thursday. They had gone up to I think I got him around $80, I think, but they went up to 86, 88, and I had a dilemma at that time. Like, okay, so I only bought 20 shares of them, but they went up $8, and I was there. Do I just sell, take the profit now? But I wanted to wait. I just wanted to wait and see how it played out. They on ex dividend they were trading at $88, and then the day after, obviously, not the day before ex dividend they were trading at 88. Then they go to ex dividend. You can sell that day. They dropped straight down to 76. So I had lost €4 or $4 per share, but then the $17 on top of that outweigh. So it was $13 per share that I made. Take away tax was around 10.40 per share. So roughly around $200 for a week's work, which is not bad.
Wow.
It's not a bad strategy for someone like a really high yielding company like this that you have no interest in keeping long term. So I found it quite well, but it was an interesting dilemma. I probably would have made how much 20 by 8. Yeah, I could have sold him. I could have sold him and made just nearly as much money as well.
Yeah. And then it's really interesting then if you know the dividend irrelevance theory and such, right?
Yeah, I mean, you know that it's going to drop, but my concern was, is it going to drop by $17? And that's
Yeah.
the big thing. Is it going to drop by $17? In this case, it didn't. But what I have noticed, I've done this a couple of times, a couple of different companies, and depending on when you buy, particularly companies of a high yield, it seems to be like a week, 2 weeks before is a better time to buy. It always, I don't want to
Runs
say
up.
always,
Yeah.
but it seems to run up, especially when it's a big dividend. It seems to run up. You have investors coming in chasing the dividend yield, and it runs up. And sometimes it might be best to sell the day before ex dividend date. You don't get the dividend, but you get the price appreciation, which is, I mean,
If
essentially the
if
same
it
thing.
already was more than the dividend, you could sell it as well.
Yeah,
Yeah.
or if it's
Yeah.
close enough to the dividend, because we know it's
Yeah.
going to drop. But it was an
Yeah. Yeah.
interesting. I kind of wish I bought more. I was going to buy 100 shares. I said, you know what, I'll just tread gently and do 20. But it was an interesting experience, and I think BASF. I did it on BASF last year,
Hmm.
and maybe they might be worth revisiting as well.
Ah, super, super. So, thanks for sharing that experience as well, Derek. I might want to try such things as well. And BASF is coming up anytime soon. So,
Yeah, the only caveat I say, like I did write an article at the start of the year when I've tried it and it's failed. It doesn't always work. It's not a golden egg. It doesn't. But
mhm.
I think the timing of when I did it the last time, I bought 2 days before the ex dividend date. I think the timing of buying it, especially maybe European companies with a higher dividend yield, you might see that ramp. So I think the timing of buying the stock is just as important as
Yeah,
anything else in this.
yeah, and only for stocks you also want to own, right? So, what I want to do with BASF is buy them, and then also sell a call option. So I also get the option premium on top of it. So
Yeah,
that's my goal there.
yeah, sweet.
Good. Last but not least, then any stock pick, any stock that you would like to bring under the attention of our listeners?
So there was a stock brought to my attention by some wise man, but there's a company listed on the London Stock Exchange. The ticker symbol is DCC, and the company is called DCC PLC. I always thought that they were in a UK British company. I always see them in Irish airports all the time, Dublin Airport, and I associate these as a sales company, a marketing company. Turns out that they're Irish. I did not know that. And it turns out that they have an impressive dividend history. I don't think they've cut it in the last 20 years. So they might even qualify.
27 years.
27 years. So they might even qualify as a Noble in the Noble 30 index. What perplexes me about the company, I just went through the numbers, and the numbers look revenues increasing. It's a really low margin business as well. You're looking at gross margin down in the low teens, so it's really low margin. But the debt is manageable. Raising cash flow is going up all the time. I think the payout ratio is around 20% free cash flow, 30-40% of earnings, which are all going up. They don't buy back shares, so there's no manipulation that way. My thing is, I need to understand this company a little bit more. I had them as a marketing group, and certainly when you look up the company, it says that they are a leading international sales and marketing group. But then you look at the sector that they're in, and it says energy and oil. So it's a little bit confusing. They also say they operate in four divisions: LPG, retail and oil, healthcare, and technology. So it seems like there's a lot to unpack on this company. It seems to be that they're a little more involved than I thought. A little bit of reading has suggested that they've bought out some companies, oil companies over here, and rebranded them. So it'd be interesting to unpack them. But from a financial point of view, they look completely interesting. They have escaped all my. So I wrote an article, the Irish Five. I had five dividend stocks from Ireland. I thought they were the only five. This company slipped my radar. I'm now wondering what other companies slipped my radar, because this one, it looks to be the best of the lot, which is quite surprising. So
Yeah.
I'm going to do some reading. I'm going to do an article, uh, just to understand what the company do before I invest. Typically, right, what I would have done in the past, I would have seen those numbers and just invested. But to practice what I preached earlier, I want to try and
Yeah.
understand the company, what they do. I see their share price hasn't moved in like 10 years. Why hasn't that moved?
Mhm.
Um, just understand the business. But from a financial point of view and initial screener, they are certainly on my list to go through, and they will be on. They'll be the next one I study. So I will write an article in the next month on these.
So ticker symbol DCC
Yeah,
on the London Stock
London
Exchange.
Stock
And I
Exchange.
was thinking, if it would be marketing for an oil and gas company, I mean, how much do you want to pay for a slogan? I mean, I would just put something like, once you go black, you never go back, right? That's the only thing you need for oil company. How much
Ma-
marketing can you make?
Maybe, but see, that's what's confused me about this company, because I know they took over the gas company and
Yeah.
renamed them to Flow Gas. I don't know if you have Flow Gas in
No.
Poland, but we have them here in Ireland. So that's what's confused me. Are they just a marketing and sales company, or at what level are they involved in if they're buying companies and
Yeah.
rebranding them? So
Maybe like a Berkshire Hathaway.
maybe, yeah, it'll be
Yeah.
interesting. And if there's any Irish listeners that have in-depth knowledge, ping me an email and give me your thoughts. Or if there's any other Irish companies that I've missed that pay dividends, particularly as strong as these, also ping me. I might have to rename my article to the Irish Six or something. So,
Good. Hey, we came to the end of the show. My throat starts to ache a little bit again, so it seems to that we just made it on time. Derek, thanks so much.
good. Hey, it's been a pleasure. Good to have you back. Get some rest, and all our listeners again. Thanks a million. Thanks for your patience. And we know we missed last week. We tried to be consistent, but last week just was not possible. But thanks for sticking around, and we will see you all next week.